Right in. Joining us now are Stephen Whiting, Global Chief Investment Strategist at Citi Private Bank, Subhadra Rajappa, Head of U.S. Rate Strategy at Societe Generale, and Julia Coronado, Founder of Macro Policy Perspective. Subhadra, I'll start with you. Do you believe there is, as Rick said, approximately a zero, no chance at all of any hawkish turn by the Fed today?
I agree with everything that Rick said. I think it's going to be very, very tricky at this meeting what the Fed says. In some respects, they have to sound optimistic, but at the same time, they have to be very careful in not sounding very hawkish. And that, I think, is going to be very, very difficult because, since the last time they upgraded the summary of economic projections, we've gotten close to $3 trillion in fiscal stimulus, which means they're going to have to upgrade their GDP forecast. They're going to probably reduce the unemployment rate forecast. But what do they do with inflation? So the bond market's very, very concerned about the what ifs, because what if they did believe and show in their economic projections that inflation is going to go higher? Then they're going to have to adjust the 2022 and 2023 dots, to sort of counteract that rise in inflation. Those what ifs are what the bond market's really concerned about.
Yeah, well, right now, Stephen, if you look at those, and I hate talking about dot plots, but I guess they matter. There's one dot above. It's a flat line for this year, pretty much a flat line for next year with one dot up, I think, 25 base. I mean, it's ridiculous and everything like it. But should they just put out the same statement they did at the last meeting? Because if they change the language, even by a word here or a word there, the market's going to read into it.
You have to really ask, is it the bond market or the economy that needs the rescue, right? We have a richly valued bond market. It's more rich around the world. I know that we've had a 40-year bull market in bonds where yields always came down and rarely stayed up for very long. But we've had yield curve steepening in every economic recovery, even prior to that secular bull market. And if the Federal Reserve wants to somehow stomp down on the long end of the bond market, somehow target long-term rates, it's going to take a lot of firepower, a lot of easing in the face of this. And as you just heard, we've just now had an additional $2.7 trillion in stimulus this year while we're coming out of COVID. GDP growth could be close to 6% this year. Inflation for the rest of the year will be over 3%. And you can see this already in pricing. Now, that's not permanent. When you have these sorts of stimulus efforts, as we saw in Japan, there are going to be many times it's not going to be a permanent new rate of growth, but they're going to have to, again, articulate that we can suffer through this as a bond investor for a while, and in the long run, they will do the right thing and normalize policy, but that's still way out there.
Julia, I don't know if you ever saw the documentary Man on Wire about Philippe Petit walking between the World Trade Centers as well. I kind of feel like Jay Powell is that person on wire right now, along with the rest of the Fed. And, an error here, an error there, given the trillions on the balance sheet. I mean, let's not forget the Fed's balance sheet is basically double the annual budget of the entire United States of America. 6 or 7 unelected officials are running a balance sheet twice as big as 535 members of Congress. Do you think Jay Powell has what it takes to get from one to the other without falling?
Brian, I think in some senses what Jay Powell has is an embarrassment of riches. For years, decade even, the Fed has been hoping for more effective fiscal support for the recovery, never got it, had to repeatedly do QE. Now, for the first time, the Fed has a partner that is going to more effectively channel resources into the economy. And all it has to do is say it's going to be patient.
Shepard Smith here. Thanks for watching CNBC on YouTube.